everyone, and welcome to the Ellig Group webinar on climate risk considerations for financial institutions. I'm Nicole Sandford. I'm the board services leader for Ellig Group. And for those of you who are not familiar, we are a search firm located in New York City that's been dedicated to diversity, equity, and inclusion since its inception. I'll be your host for today's program, which is part of a series of discussions with thought leaders and subject matter experts on relevant topics for some very unusual times. I'm absolutely delighted to be joined by two of my favorite people, Kristen Sullivan, Global Sustainability Leader for Deloitte, and Ed Hida, recently retired Deloitte partner and a world-recognized financial services risk expert. Just a little bit of background on each before we dive in. Kristen leads Deloitte Sustainability and ESG Services for the Americas region and serves as Deloitte's Global Audit and Assurance Climate Services Leader. She represents Deloitte on a number of the leading ESG climate standard setting initiatives and serves as chair of the AICPA's Sustainability Assurance Task Force. She's authored a number of publications on the importance of high quality ESG and climate related disclosure as a means to enhancing trust and unlocking capital. She's truly one of the most knowledgeable experts in the field. It's a real coup that we have her this week in particular during a Sustainable Finance Week. So Kristen, thanks so much for being here with us. And Ed Hida, he spent over 30 years leading risk projects and various risk management practices at Deloitte, where we had an opportunity to work together. Retired after 20 years as a partner. He is the go-to expert for some of the world's largest global banks and US-based banks across the entire spectrum of risks. And he's usually the first person I call on topics like the one we're talking about today, because there's nothing he enjoys more than helping companies and colleagues to think through new and emerging risks like climate risk. So Ed and Kristen, thank you both so much for being with us today. I think we're gonna have a fantastic conversation. So the idea for this webinar came out of a recently published piece that Deloitte published called Creating a Climate of Change. It's this piece that in the chat box in just a second, Elaine will pop up a link and we'll also include it in our follow-up email as well, which is obviously really well-written piece, very timely. And so, I'd suggest to everyone on the call today to please download the report. It's worth reading. But I want to start with something a little basic, Kristen, and then Ed, I'll have you comment as well. Just start out by defining climate risk and explain to those of us who don't live in this space how that's different from sustainability and the other terms and catchphrases we may have heard along the way.
Great. Well, thank you, Nicole, and thank you, Ed, and I'm so pleased to be here today. It's a really important starting point in terms of what you could argue is definitional confusion that has been starting to converge towards more clarity in the market. We've seen climate command the headlines for the past year or so, and really with the COVID effect, we've seen climate reemerge as top of the agenda in terms of this broader environmental, social, and governance space. There are a lot of terms, and I think the capital markets in particular have really coalesced around ESG, meaning environmental, social, and governance concerns, while climate is a dimension within that broader umbrella. I think in a lot of cases, people just the collective marketplace, narrowly organize climate just under the E. And one of the big ways to demystify and I think drive more clarity around climate risk in particular, is that it really permeates all dimensions of ESG. When you think about how pervasive, and we continue to hear the reference to systemic around climate risk, and clearly the E is an important dimension when you think about more physical risks, the severe weather patterns we continue to see elevate, increase in intensity and frequency. But when you think about the other dimensions, you think about, workforce disruption, you think about supply chain disruption, you think about business model disruption in this rapid move towards a decarbonized economy. And I think that brings us to even the further emphasis on the relevance to financial services in this context, as we see the momentum and these trends evolving so rapidly. So a little bit of an overview there.
That's helpful. Ed, what would you add to that?
Yeah, and thanks for having me on. This is a very timely topic. I certainly agree with Kristen. I just wanted to add on, a few bits. When you get into climate risk and climate risk definitions, and I think definitions are very important in financial services because they then drive things like risk taxonomy, risk identification processes, risk appetite, and ultimately risk monitoring and reporting and the actions that you take. So definitions where you start up front, very important. So, we're talking about climate risk. I think, and Kristen started to get into this, but I would note that many of the leading organizations have defined some subcategories for climate risk as well. So there's different types of climate risk. There's physical risk, and that's the risk of possible extreme events happening due to climate change. And sometimes that's further broken down into acute events and chronic events. And the idea is that acute events come from really extreme events. Chronic events come from events that kind of build up over time. So ones that are more gradual, but still become significant events. So that's physical risk. Then we talk about transition risk. That's the next subcategory. And that's talking about things that result from mitigation activities as the society decarbonizes and the changes that are going to go on a larger basis, and the possibility that that'll have shifts to the economy, to how firms are positioned, and their results and things like that. So that's transition risk. And then we have liability risk, and that's really kind of the last subcategory. And that has to do with the potential that someone could seek claims as a result of climate-related events that occur that are found to have happened perhaps as a result of one company or organization, or perhaps something a company did or didn't do to protect itself, or maybe others that are involved in transactions with it. So that's liability risk. So I think it's important to have those categories. The other thing I just note on this topic around definitions. So we talked about how climate risk is important as a definition, these subcategories. It's important for a risk taxonomy and the like. It's also sometimes important to think about how climate risk then pervades into other risks of the organization. And a couple examples I'd give are credit risk, and I think we may talk about this a little bit further, but climate risk has the potential of impacting credit risk, where the climate risk could impact borrowers and their well-being and their ability to repay their loans or transactions. So to really completely analyze that, you need to understand what the impact is from climate risk to that borrower. So that's credit risk. And what we actually see is sometimes in their credit risk definitions, people embed elements of climate risk in there so that they're more intentional about climate risk when they think about credit. I'd give you another example of another type of risk, like third-party risk management, where we're talking about third parties that the organization does business with. It's important, similarly, to know if those organizations are exposed to climate risk, because that could impact their ability to deliver the services that the organization's depending on. So commonly, organizations do third-party assessments, again, building in a climate risk component to make sure that that assessment is very intentional and considers this risk is very important. So important stuff to really build into the foundation going forward. So back to you, Nicole.
Yeah, it sounds very far-reaching, a lot more far-reaching than maybe on the surface one would think in this context. I want to take us to the big picture and talk about how we expect to see climate risk and the business environment around climate risk evolve in the next 2 to 3 years. And as much as I hate to bring politics in it, it would be a little ridiculous to talk about that without bringing in the political climate and how that might influence your answer to this question. So, Kristen, I'm going to start with you. What do you think is on the horizon?
Yeah, thanks, Nicole. And it's sort of the elephant in the room. To your point, there's been such a dramatic shift in the conversation in the last couple of months, and I think that even comes on a 12 to 18 month period where the conversation, again, from a capital markets perspective, has really been gaining momentum. And I think it's just building off of some of Ed's comments, just this fundamental recognition that ESG, climate in particular, these are fundamental business risks and opportunities. These are no longer these feel good, nice to have, disconnected from the business sort of activities. These are fundamental to how you think about your business model today, your strategy, the dependencies you have on stakeholders and resources, how you're vulnerable to disruptions from a societal and environmental standpoint, and then how your business is impacting those and the perceptions of how you're delivering and the likelihood that you'll be able to deliver value into the long term. And so I think this momentum is sort of culminating in signals that we're seeing with the anticipation of a new administration. There's a lot of things you can unpack there, but I think very clearly, even this week, Sustainable Finance Week, we've heard, from SEC commissioners talking about giving some indications as to where the SEC could likely be headed, and I think we will see some regulatory action very, very soon, and that's all importantly, while we don't have a crystal ball, it's importantly a signal to behavior change that we're starting to see, even absent clarity around what the regulatory, the policy, the legislative environment might look like. Just 2 weeks ago, we saw the Federal Reserve for the first time declare climate risk to be a systemic financial risk and committed to joining. They've now applied to join the network of the central banks around the world to really put an emphasis on climate risk from a financial stability standpoint. You've started to hear the reserves around the country start talking about climate more intentionally. And so I think it's just a momentum that we're going to start seeing accelerate very rapidly in the US and also global. We've seen global markets in particular out of Europe really moving quickly and really tying the sort of the green strings attached from a legislative standpoint. I think we could see some of that start to permeate into the US now that there's a more receptive environment, or at least one that we expect to be more receptive.
First of all, if you look at President-elect Biden's campaign platform, his campaign agenda, it was fairly, pro-environmental, focused on climate. There's a lot of things that he laid out there that would seek to become, drivers to policy going forward. So I think that's a starting point. Clearly at this time, the outcome of the composition of the Senate is still to be decided by the runoff elections in Georgia. So that has a very material impact on whether we're going to have a divided government or not, and what the impact could be on legislative change. I think most right now would say it seems maybe a little unlikely that that we'll have a unified one-party government, and as a result, if that is the outcome, then larger legislative change on this topic seems unlikely, and then we're more likely to be in the realm of executive orders, regulatory action, and there's a lot of things that can be done with regulatory action, both from new regulations as well as regulatory examination and enforcement. And if you look at some of the indicators of the direction to travel there, and I think Kristen named a few of them. I'd add a few more. And I think one of the sayings in Washington for a long time is that personnel is policy. So who is involved, who's in the room, it shapes what will become the policy. And if you look at President-elect Biden announced that John Kerry will be his climate czar. Very senior, former senator. He's also a prime mover behind the Paris Climate Accord. That's a very significant development right there. Janet Yellen also, as the Treasury Secretary, announced, is another indication. She previously chaired the Group of 30's working group on climate change, and they released a report calling for government and regulatory action. She'll also chair the Financial Stability Oversight Council, or what's called FSOC. What the FSOC is a large coordinating organization of all the regulatory agencies, effectively financial services regulatory agencies in Washington, and help set their direction and policy. With Ms. Yellen as the chair of that, she'll be in a place to help set direction and policy on regulation. including regulation for climate. So I think there's a lot of things that are kind of indicating that there will be more and more focus on climate from a, I'd say, regulatory perspective. I think, again, still waiting to see what happens with the runoffs and possible legislative action, but I would expect a fair amount of regulatory action, both in terms of regulations themselves, as well as the examination and enforcement posture that the major agencies take.
So it may be that the regulatory honeymoon that some of the financial institutions may feel they've been on is about to come to a close, regardless of what happens with the Senate, is kind of what I'm hearing from you guys. So, interesting perspective if you're on a bank board, interesting perspective to hear that from you. I actually think I want to stay with that that banking perspective, Ed, and ask you, you've worked in risk your entire career and financial services and banking for most of that time. So, if not all. You guys make a case in your recent paper that climate risk ought to be a business imperative for banks. You've touched on this a little bit, but take us a little bit deeper. What drives that in your view, especially if you're thinking at the CEO and board level?
Yeah, and I would say that I would expect regulatory change on the climate risk topic and more enforcement coming in that area. In addition to some of the other things we've talked about, the CFTC issued a major report. They identified climate risk as a systemic risk impacting the U.S. financial system. That's a very significant finding, and that suggests that more specific action is needed to be taken by regulators and that banks will need to respond to that. The New York Department of Financial Services also recently issued a letter, somewhat similar, but called for banks, covered institutions by them, to build in climate risk into their risk management, their governance processes, into their disclosures, importantly. They also applied, similar to what the Fed did, that Kristen mentioned, but applied to the Network for Greening of the Financial System, which is really a large international coalition of central banks and regulators. And the whole idea is to bring about a more global regulatory response to climate. And if you have organizations like the Fed and the New York DFS joining that, clearly, they're looking to establish more global expectations and standards, bringing those here to the U.S. Around climate. So I'd certainly expect those areas to happen. The Federal Reserve said climate risk was a systemic risk. I think Kristen noted that, but again, very significant. And I found one other data point to be kind of interesting. It's a little bit, you could think of it perhaps as contrary, but I think it's actually a source of complexity. And the OCC recently issued a notice of proposed rulemaking. And what their notice of proposed rulemaking said essentially was that institutions could not effectively eliminate, or you could say discriminate against an entire industry or class of customers, and ones that would be perhaps deemed unpopular. The gist of that is that it would actually prevent institutions from stopping to bank climate-exposed institutions, climate-exposed firms, perhaps carbon-intensive firms and the like. And so what they're saying is that—
So wait, Ed, before you go off of that, just to make sure I understand. So are they saying because you can't discriminate based on the fact that they're in an industry that climate risk would expect it to be, it's got to be more specific to the company, or the specific to the, instead of we're just not going to lend to XYZ sector anymore. We have to be, surgical and actually analyzing the credit risk for the individual companies. That's pretty interesting too.
That's exactly right. And I think this started in a broader manner. There was concern Banks and others were getting pressure that they shouldn't lend to some industries, perhaps, sin-related industries or weapons, guns-related industries,
Right,
in this
right.
case, climate-related industries. And what the OCC has said, according to a reading of the Dodd-Frank Act, is that that would constitute discrimination and a loss of ability, access to financing by those type of institutions. So while some might like to restrict the access of lending to carbon intensive industries, this would actually say that that can't be done. As you suggested, firms could apply their own risk analysis on a firm by firm basis and decide that a certain firm that happened to be in that industry was too risky, perhaps because of those considerations, and decide not to lend to it. But they couldn't do that on a blanket basis.
Right,
And
right.
I
That's
guess
really
my
interesting.
point is really that it becomes then perhaps a more complex issue of managing climate risk, because you can't just sort of turn the toggle off or turn the valve off and say we're not going to lend to or do business with a certain class of customers because of our concern or exposure. You actually have to go down and do the detailed analysis of each individual firm, and you can't just sort of do a broad brush approach. So
Yes, there's no magic bullet for this.
That's
Yeah, I
right.
mean, some might want to have that, but there isn't going to be one. And that actually, Kristen, you actually have not spent your whole career in banking. You've been focusing on this issue across a lot of different industries and a lot of different dimensions. So I'm going to ask you to build on what we were just talking about a little bit. And what have you learned from your work with commercial and industrial companies that you're now taking to your banking clients, and how is that informing how you're advising financial institutions?
Yeah, it's such a great framing, because when you think about banking, those of you who are very ingrained in banking, banks are such the linchpin within the capital markets. So there's sort of a pervasive considerations of risks across all sectors that factor into decisions and strategy the banks deliver on. And I think it just further elevates this awareness, this attention to looking at climate risk in particular as a business risk. You think about your business model. Again, it's not about sort of the peripheral set of activities that are undertaken, but really thinking about the business model, thinking about the strategy. How do I think about my supply chain today, but what my supply chain is going to have to look like if I factor in all of the scientific evidence and understand the value at risk in different areas of my exposure. Again, sticking with the manufacturing example, but it very much just makes the conversation so much more fundamentally business model and strategy aligned, really promoting, and that's sort of the role that we've played, myself in particular, from a Deloitte perspective, in helping to create the market infrastructure that enables more efficiency, first and foremost, of the data value exchange in the market, because there's such an appetite, this insatiable appetite by every market participant for meaningful, high quality, accessible data to inform decision making. If you're that manufacturer, or if you're engaging with a lender around some sort of a facility, and what are those measures as you think about your strategy that are lending themselves to be able to demonstrate how you're minimizing your long-term risk exposure. How is that going to appeal to credit raters who are now very intentionally factoring in ESG factors in very fundamental credit worthiness analysis, in terms of thinking about the exposure in a much more segmented and more precise manner, in terms of really what are the vulnerabilities out there, and how do you factor that in more intentionally into traditional models of credit and broader stress testing consideration. So I think there's a very interesting intersection that might not be evident in terms of thinking about industries that are just naturally more environmentally intensive, exposed to more labor and human rights concerns from that dimension. But banks really need to be very, very aware and very intentional about understanding the risks as they manifest themselves differently across different industries.
Well, it's a perfect segue to what I wanted to talk to you guys about next, which is, there's two sides of this coin when you start talking about risk for financial institutions. Yes, there's a downside risk, but risk is actually how banks make money. So where is the upside? Where are the opportunities, and what are smart institutions doing to capitalize on that now? And Ed, we'll start with you.
Yeah, I'll cover a few of the bases, and I know Kristen's also done a lot of work in here. But first of all, I'd say the whole area of ESG and green finance and climate finance provides new business opportunities. I think we've seen some analysis that the value of green bonds traded was, several $1 trillion. The overall sustainable finance market being actually much bigger than that. So it's already a sizable market. But if you look at growth rates, this is one of the fastest growing areas of of finance, and clearly there's a lot of opportunity there. If you look at also interestingly, I looked at issuers. I guess maybe it's not surprising, but the U.S. is by far the biggest issuer of green finance, green bonds, and the like. So there's a very huge market for this right here. The second thing I'd point to, besides just the market, the growth, and the size, is performance. And if you look at the performance of ESG-related funds, for example, I know that S&P and Morningstar have done periodic studies of the relative performance of those funds relative to the broader market, things like the S&P 500. And the last one that I saw that in the first half of the year, I think it was 14 of 17 ESG-related funds outperformed the S&P 500. So, clearly there's a performance expectation there, as well. And I'm not predicting future investment returns. I'll say that, but clearly, there's an interesting, variable there with performance that we're seeing, and I think disclosures start to come in to be a very interesting area as well. And I know Kristen's done a lot of work in this area, but I'd say, there's certain expectations and requirements for disclosure. And those are going to become now, and are becoming already, something that investors are looking for. So they're looking for organizations that, first of all, do disclose. Second of all, they're looking at the nature and type of disclosures to indicate that they're following the right practices in climate, and that's where they want to invest in. And so there are certainly opportunities for upside throughout green finance, climate finance, and the like. And I think it's going to become a ever increasing area, of our financial markets, our capital markets. So, Kristen, I'm sure you have thoughts on this as well.
Yeah, absolutely. And I think there's always the entry point with ESG climate is generally starts with risk, but you very quickly move to the opportunity side of the equation, because this is all about how are the markets is all focused on sort of delivering on long-term value. And there's been a lot of emphasis around stakeholder capitalism, purpose-driven organizations, and those, as Ed mentioned, who have demonstrated that they have contemplated the needs of a broader universe of stakeholders as a means of delivering long-term value are outperforming. The proof points are there. It's very different than it was in our last downturn. From a financial services institution standpoint, at the international level, the conversation has been so centered around how to truly direct capital to delivering on sustainable development, and the role, and that's why there's such an emphasis from a policy, legislative, regulatory standpoint on the role of financial institutions as instrumental in driving this move towards a decarbonized economy, move towards a broader, stakeholder engaged way of doing business. And so banks in particular are making very bold, ambitious goals around green finances, as Ed mentioned, and the proof point is there. That's where the alpha is starting to come from. Increasingly, investors are seeing from a mandate perspective that if you're not intentionally integrating ESG factors, you don't have a policy and a systematic way to consider risk and opportunity and measure that performance, then you're really going to start losing out on that allocation of capital. So I think this shift in mindset from this is all about minimizing the downside risk to how do I truly deliver value through an emphasis on ESG? And it's not just about sort of, CEO messaging. It's truly how do you embed these considerations into your growth strategy?
Thanks, Kristen. So, we're going to get close to the wrap up time. I have two more things to ask you guys. I'm going to ask you to sort of pretend that you're putting on a hat as a CEO or a leader within a bank today. What are the one or two most important things you would do to sort of up the game for that institution around climate risk right now? And Ed, you go first.
Well, and thanks, Nicole. As maybe you know me, I'm not sure I can contain it to one or two, but I'll try to these six things
Let's
here.
see. Miracles happen every day, Ed. We can try.
First of all, appoint a senior executive responsible for climate risk across the organization. And I think, it's very important. They need to have the clout. I would say looking at climate risk should report into the risk framework. So probably reporting into the chief risk officer, having some type of visibility with senior executives and the board as well directly is very important. I'd make a brief note. I know some organizations have been appointing chief sustainability officers. I think for a large bank or financial services firm, I would look at climate risk as a little different than the mandate of the sustainability officer. And it's possible they may even need both of those roles or something like that. I look at one as more directly on managing climate risk. Second of all, and we started to talk about taxonomy before, I would include climate risk in the risk taxonomy formally. I would include it in the risk appetite framework. I would include it in the risk management framework. And once you include climate risk in your taxonomy and your risk appetite framework and your risk management framework, then that's the way to make sure that it gets managed according to the standards that you've set up across the organization. Thirdly, tools. We need tools, we need data, we need analytics, we need models. And I will say, I think we've touched on this, but I will say climate risk is a different kind of risk than many of the other risks. You need different kinds of data. You need to be able to look at counterparties and borrowers, obligors in a much different way than you have in the past. It's going to need time to prepare to get that data and to perform those analyses and to be able to bring that into your tools and analytics. I would include stress testing ultimately and scenario analysis along with those tools. You want the tools to be able to be specific and actionable enough that they can power stress tests across your portfolios to understand what the impact of different climate scenarios are on your lending portfolio, your counterparty risk portfolio, et cetera. I'd bake it into underwriting standards. So you need to know, are we accounting for climate risk in our new transactions that are coming into the organization? Have we fully baked that into the decision making? So on the front end, are we dealing with it there? So that was kind of a handful of things. I would say, I think in my view, that's kind of a lot to bite off actually. I'd say one way to get started would be to do an assessment. Let's look across the organization, across all these areas and understand what is our readiness and what's our portfolio look like and what types of business are we in that expose ourselves to climate risk. So that would be a good way to get started, but ultimately we'll need to address all of those items across the organization.
Yeah, and I guess it probably doesn't matter whether you're talking about a small institution or a large one. Some institutions will be further down on the journey of doing what you just said, but it's got to be far more complex when you're looking across a portfolio, tons of different business lines, different geographies. But large or small, I think you really have to be focused on doing all the things you just mentioned. Kristen, what would you add to that task list?
Yeah, no, I was going to say Ed just provided a great roadmap there. So hopefully,
and he only did 3, so one of them had a few threads on it, but that's okay. We'll let it go.
there's been a trend, and we continue to see this trend of appointing a chief sustainability officer, right? A leader, a champion that has the ear of the CEO, that has the ear of the board, to really establish that central, effective, and just an organizational capacity around how do you establish some intentional organizational and enterprise-wide emphasis, a signal that this is important, this that really helps drive the focus and then therefore the investment that's going to be required to really derive that return, and kind of build of that sort of management capacity, and this idea that a chief sustainability officer is evolving, and depending on where that role will go. I think what we have seen in financial services in particular is large institutions appointing or elevating chief sustainability officers to have that direct line to the CEO, which really signals to the market that, look, this isn't just a hobby or a side job that's on someone's list of to-do. And then that allows the board to more effectively organize around, how do you oversee this from a risk and opportunity standpoint? What's the structure from a committee structure standpoint? And I think what we've seen, and this is evolving rapidly too, where boards, assign this, depending on how broadly you define it, topic to one committee. And I think what we're starting to see is a recognition that other risks the business, there are different considerations, whether it's the non-gov committee, whether it's the audit committee, whether it's the compensation committee. There's just a different lens that you can apply in truly, promoting effective oversight and properly not only advising management, but properly challenging management.
Well, you jumped right into my last question. So Ed, you're going to get the last word, because I think Kristen gave us some good running start on the question about board. I know that in your retirement, you're seeking a board role, and most of the people on the call today are on boards and most likely on bank boards. So, from your perspective, what's the right thing for the bank board to be doing to make sure that they understand how the institution they're overseeing is on top of the game here?
Yeah, so I think when looking at the role of the board, we need to start with and remember, of course, that the role of the board is all about oversight, and through the process of asking the right questions of management to understand how's management driving this topic, climate risk, in the organization. What is the organization doing? So I would start there, and then questions I would think that a board should ask relate to some of the topics that I touched on before, around how climate risk would need to be managed and spread throughout the risk management process of the organization. So again, I would ask, if I were a board member, who's responsible for climate risk in the organization? Then I'd ask about, and you can ask follow-up questions. I'd ask about their seniority. I'd ask about their reporting. Who do they report to on an individual basis? Who do they report to on a committee basis? I'd ask about, I talked about integrating climate into some of the elements of the risk management framework and structure. So that would be, is climate risk named in the risk taxonomy? Is climate risk named in the risk appetite statement? Is climate risk named in the risk management framework? And does it account for the management processes that we need to manage climate risk as a risk across the organization? If not, why not? And how and when is it going to be baked in? I talked about how climate risk is a little different than some of the other risk types that we have in terms of the types of data and analytics that we're going to need to be able to monitor and measure the climate risk of our counterparties and those we transact and deal with. So questions around that would be, what type of data do we have? What portfolios are more exposed to climate risk than others? Do we have systems and tools to measure and monitor climate risk? How often is that done? What's the data quality there? Have we been able to perform stress tests or scenario analyses of these portfolios to understand which portfolios are more exposed to climate risk than others? If we have been able to perform those analyses, what do they tell us? What's the relative level of exposure, and what types of climate events might we be more exposed to in some portfolios than other portfolios? And are there actions that we can start to take as an institution once we have an insight into our exposures? Can we do things like perhaps do some kinds of transactions that might alleviate or hedge the bigger concentrations of exposure that are resulting from that, from what we've found from our analysis. But it starts with having that data, the analytics, the tools, the capabilities, and then you can ask more questions around that once you start to get some of the answers. I talked about including climate risk into underwriting in new business. We should understand how that works. And I also talked about, as kind of a wrap up, have we done a risk assessment for climate risk? That would be a nice way to look at holistically across the organization what our readiness and capability is. And I think as a board member, I would want to know the answer to that, to understand the organization's whole capability to manage climate risk. So those are a few areas. I think there's a lot of different topics. As I say, those questions can get into different levels of detail depending on the type of response and answer you get. I would certainly follow up on those because this is a big one that's coming.
Yeah, I mean, I think it's fascinating to me because the first question I think I would ask it on a board is, when are we going to be ready to break up ESG? Because I think a lot of companies are still presenting their risk dashboard to their boards with ESG as like a single thing. And I don't know about from a banking perspective if that's already started to happen, but even just that fundamental first step of pulling climate risk out to be a separately considered item within your risk framework, I think would be a huge first step. Basic, but a good step. So. And I think we're pretty much at time. You guys did great. This was so much fun. Thank you both for spending a little time with us today. Just a reminder to everyone, the links to the report and a Wall Street Journal article on the report are in the chat box. So please feel free to grab those. I think good reading, definitely worth your time. And thanks again, Ed and Kristen. As always, it's a pleasure just getting to spend some time with you and hear your thoughts on some critical issues.